Hello and welcome back to the Financial Streams podcast. I'm Patrea Brown and with me today I have
Andrew Lettingham.
And our hot topic for today is end of financial year planning. Yes, so we're going to dive in just with an overview of what we like to talk to clients about at this time of year and make sure that you're ticking off all the boxes and making sure that you're thinking ahead for tax strategies and other important things, all before June 30.
That's correct. I guess what today's about is just giving a snapshot of what we need, I suppose, for our clients within our business as such. There's wider needs that you might have in terms of requirements from accountants that you might need to meet that outside of the scope of what we're going to chat around today. Because it depends on your structures that you have as well.
And that is a good point. We always do a disclaimer to say that this is just a general discussion. It doesn't constitute financial advice, and you do need to talk to a professional about your particular circumstances before you make any changes or decisions.
Yeah.
Yes.
So today we thought we'd just talk through typically what we would normally discuss at the end of the financial year with our clients. Some of the tools that we need and some of the resources that we need to make the best outcomes. And also I suppose at the end of the day, strategies are only as good as their funding, and making sure that that's achievable in a client's world as well.
Yeah, absolutely. So I think if you're happy for me to jump in and pick your brains, I think that as you're approaching the end of the year, one of the really important things to go back to is your pay slip, so that you can understand what you've been paid and the breakdown of it, and to see, some people might have salary sacrifice arrangements in place where they've got some money going into super that's on top of what their employer's putting in. And I think if you're going to start to consider making tax saving strategies around that, it's important to know what's going in. And I think that I probably actually jumped ahead there, and that we should go back to basics and say, so as we're approaching end of financial year, what are the current caps in place for what contributions you're allowed to put into super this financial year?
Yeah, so the general cap is 30,000. So, and that's a pre-tax contribution, and that's made up of your super guarantee payments that you've paid through, any personal contributions where you're claiming a tax deduction, and the other one that pulls up a lot of clients is if you've got any superannuation payments that you're making contributions in and are paying for insurances inside super, that can also be captured under this as well. So they're kind of the main things that we look for. And I suppose the reference point that we always look for at this time of the year is just grabbing a client's payslip, see where they're at for the contributions for the year, because we want to make sure that you maximise where you can, but we don't want you to go generally over the caps, because then there's then a consequence that you have to pay further tax, or you then have to go through a process where you request for funds to be released from superannuation, which is can be annoying, and it goes through the tax office.
Yes.
And the other part we have in our mind is, are there any additional contributions that can be utilised from previous years, and that's important as well under the carry forward provisions.
So just so I'm clear on my understanding, so you're saying that there's a concessional contribution cap this year is 30,000.
Correct. Yeah.
That's made up of your super guaranteed from your employer, so 12% of your wage.
Correct.
That's going in, and then any additional contributions you've made yourself through a salary sacrifice, or if you've popped it in yourself.
Yeah, so the two main ones under that type of additional contribution are your salary sacrifices you've noted, and also any personal deductible contributions. So the ones that you are personally made, but you've notified the super fund that you're going to be claiming a tax deduction on.
And that's a really key point, Andrew, because if you have transferred money just into super as a personal contribution like that, it is assumed that it forms part of a non-concessional basis unless you notify them of your intent to claim that tax discount.
Correct.
So that money any contribution you make this year has to go in prior to June 30 to be counted.
Correct. Yeah.
But you do need to have that notice of intent lodged with your super fund and get confirmation back that it's been received before you lodge your tax return, or you could miss out on that tax discount.
Yeah, and that's where in the past, if mistakes have been made in this, if people lodge their notice of intent to claim a tax deduction with their super fund, but they haven't received the acknowledgement of it, and then they've gone forward and lodged their tax return after 1 July, then it becomes problematic.
Yeah, and am I right in thinking that you don't have to lodge that notice of intent before June 30? You just have to put the money in. So sometimes it makes sense to actually put the money in up to what your estimate is going to be for it, and then wait until you've had your final pay slip and you've got all those numbers in, so that you can claim the right amount. Because even if you put extra in, the notice of intent tells the amount you want to claim, so you can keep it to that general 30,000 cap.
Yeah, that's right.
Yeah.
Now, it's all well and good having these caps and being able to say that this is the greatest strategy to improve your tax position for the year. But you've also, from a wider perspective, you've got to be able to fund it.
Yes.
You've got to have the available cash flow to do it. And that's where, when you're sitting with one of our advisors with financial streams, we'll work out the pros and cons of, is that funded from your own personal cash flow, or are there strategies that we can bring to the table to assist with further contributions? So without going too much specifics, I mean, is there ability for you to utilise any available cash from your mortgages, for example? You might be ahead in your mortgage and you might in that particular year be able to redraw against the mortgage to fund further contributions, or when you're in your years when you've started to access superannuation under transition to retirement strategies, can you utilise an income stream to assist with that? Now, these are just general strategies that we utilise. But what I'd highlight to you, Patrea, is not one strategy in itself is the perfect magic wand.
No.
You've got to look at how the connected dots affect your whole current position.
So it's not a one size fits all strategy.
No.
And I think there are important things you need to consider before you go, is this the right thing for me? Like, for example, with making the concessional contributions, and really a lot of it, my understanding is that it comes back down to your own personal marginal tax rate. So whether or not there's any benefit to you doing it depends what tax bracket you're personally sitting in, and the amount you put in, how that impacts the tax related to those funds. Is that right? Correct,
yeah.
Yeah.
So it's a rule of thumb, and it's a rule of thumb strategy, is that we've always thought of your marginal tax rate around about that 45,000 kind of equals the same tax rate.
Yeah, I think it's 16 cents per dollar. You'll have to check the ATO website on that, but I think it's 16 cents per dollar.
Yeah. So that's kind of always been our guide pole. You can actually do further contributions and actually get your assessable tax down to around about 37,500 with some of the tax offsets that's available. So that's important. But rule of thumb, we always go, you're getting down to nickels and dimes if you go under it.
So down to 45,000, there's normally a considerable discount because you're jumping from 30 cents per dollar down to 15 cents per dollar if it's in super. That's the rate it's taxed at.
Correct.
15%.
Yeah. And so next year is going to be interesting because the that tax rate's now dropping down to equal superannuation. So that's another thought bubble that we can discuss in future podcasts. But it sort of highlights that 45,000 is the general position that we look at.
Now, can I just revisit something? Because you've thrown out carry forward balances a couple of times in the conversations you've had. Can you just explain to me what is a carry forward balance? How do people access it? Can everyone do it?
Not everyone. So it is for people whose balance as of the June the 30th, the previous financial year, but their overall super balance was under 500,000. Yeah. And
how would you find that out? Is that just like a log on to MyGov type of thing and check what it was?
Correct. So MyGov's probably the best guide for it, with a caveat that sometimes the ATO and that sort of resource can be incorrect.
Yes.
So you've just got to double check the numbers.
I feel like that a lot of accounting teams too these days actually have the ability to check that for you as well. I think if they've got access, they can check those type of balances.
Yeah.
So it's got to be under 500,000.
Yeah. So let's just recap on that carry forward contribution. So the carry forwards, as of June 30, the previous financial year, if your overall super balance is under 500,000, then it allows you to utilise any of the contribution caps that have been available in the previous 5 years.
Yes.
Yeah.
Okay.
So that's important to know. But the other thing to note is that those contributions are not always, the cap is not always consistently the same. So it changes based on the legislation that comes out and the budgetary recommendations that happen from the government. So we're expecting as of 1 July this year that the cap will move for a pre-tax concessional contribution, move from 30,000 to 32,500.
Yeah.
And that then flows through to the non-concessional cap as well, which is currently 120,000. That will move up to 130,000.
Yes.
So that's what we expect will happen, and that's what's probably on the horizon. But as I said, the budget's next week. We'll find out if that actually does occur. But that's generally what we do. So we utilise the carry forward. So if you think about why we do this, because that's always the purpose of it, we're trying to reduce your own personal assessable tax down and transfer that to superannuation, where there's a lower tax regime.
Yes.
And so you're using that strategy, and I always look at it as being that you're retaining more of your own personal wealth by doing that strategy, because usually you would pay tax, and that tax goes to the ATO.
Yep.
You lose it, you can't claim it back.
Yep.
But the window where superannuation plays that valuable part is where you can retain a portion of that asset. And if you accumulate that over the journey, and if we look at it, superannuation as being a long-term play, then the advantages of that is that the accumulation benefits over, say, a 10, 15, 20-year period of time can be quite valuable for you as well.
So you mentioned before that the non-concessional cap is 120,000 this year.
Yeah.
You have flagged, I guess a few thought bubbles around making concessional contributions. Are there particular things at this time of year that you consider with making recommendations about non-concessional contributions, or why people would consider using that?
Yeah, so not everyone has a big windfall, but sometimes at stages in your life you get
an inheritance.
An inheritance, for example. You might have sold an asset where you can move funds from yourself into superannuation under those rules.
Yeah.
So generally we look at those milestones in people's lives, and how do we migrate funds from being in a taxable position to the eventual outcome where you would start income streams and pension phase, and you get the benefits of tax-free income streams. So how do you get money into that phase is always through the superannuation window. We always go through the accumulation phase under the non-concessional contributions, but are there any other strategies that we can utilise to get further funds in? So under the rules, there's a few windows especially that we can utilise, but that's a wider conversation because that's kind of takes you into
retirement planning mode.
How you get maximise funds into your superannuation and then into your pension, for the sheer sake of moving the majority of your assets into a tax
in a better tax environment
zone.
Yes.
But I suppose today's really just talking about
end of financial year. Sorry, to get back on track.
But it is relevant. It is relevant because those strategies are worthy. Now, there's the small 1%ers, or the ones that I feel that are oldies but goodies for strategies, and clients. We do discuss the ability to be able to do the spouse contributions,
Yes.
and also the government co-contributions. And these strategies have been around for a while.
Yes.
So
with the spouse contribution, my understanding is that if you have a lower income earning spouse,
yep.
yes, that you can make a contribution of $3,000.
Correct.
And that forms part of your non-concessional cap for the year.
Yep.
So you put that in and then you get a personal tax deduction.
Correct.
Yes.
Yeah.
Of 525 something. I can't remember what the percentages are without having the table in front of me.
It works out to be if you put the 3,000 in and your spouse is under the
threshold
the
income.
threshold, you can claim $540.
540, not
tax
520. Yep.
offset.
And those do change, so it's worth checking the ATO website. They do change what those thresholds and things are and the percentages. So to check that, make sure that.
Correct. And then that equates to an 18% return as well. Yeah. So that's a good outcome. If you've got it and you can afford to do that strategy, it's always well worth looking at.
Yep.
That in combined, and you're right, that does affect the non-concessional cap.
Yes.
So you do have to mark that as the spouse contribution.
Yep.
The other thing is, if we're doing a longer term strategy where we're trying to maximise assets in, but it still warrants doing a spouse contribution, you've got to make sure that you don't take off that table that strategy.
Yeah.
You've got to remind yourself that when you're formulating a longer term contribution strategy, that you allow to still do the spouse contribution.
Yeah,
as well.
and so I suppose, are you saying, like someone, for example, we haven't talked about this morning yet, but that, you know, with the non-concessional rules, if like you have got an inheritance or you're approaching retirement and trying to maximise how much wealth you hold in the superannuation environment, you might consider doing a non-concessional contribution via triggering the bring forward rule, so you can put up to 3 years worth in front, and if at the moment that's 360,000,
correct,
it's about to go to 390 next year, next financial year. And so if you're going to do that and you put that full amount in, that takes that other strategy off the floor. You can't make a spouse contribution after that because you've already maxed out your cap, and you can't get that tax discount. So you need to factor those things in.
Yeah. So the way we segment that is, how long does that strategy help you?
Yep.
Yeah. Then how much do we need to leave on the table to be able to allow that strategy for future years as well?
Because that could be, like, in that 3 years, that could effectively be $1,500 of tax savings you've lost.
Correct.
Yep. Yeah. So that was one of the 1%ers. What was the other one?
The government co-contribution. So that's the other one that typically you put in $1,000 and the government matches it with $500.
Yep.
Yeah. So, and we always look at these strategies as, okay, yes, they're a good strategy to build accumulation and wealth over the journey. If they're done tactically and well thought through, they can give you tax advantages as well. So if you're thinking about the return on putting $1,000 in and getting $500, it's a 50% return. Yes. But the longer piece for me is, if you've got insurances coming out of superannuation, and there's a lot of strategies where you might have your industry fund set up, and you might have your personal insurances coming out of the super fund, that then can be helped out by some of these strategies, like the further contribution that you can do for your spouse, or the government co-contribution. So it offsets those costs as well.
And that government, like that contribution that you have to make, the $1,000 or whatever it's up to, that they match up to the $500. That is also a non-concessional contribution. Is that correct? So that's part of your non-concessional cap for the year. Yeah.
So the wider strategy is, Patrea, if you're looking at a long-term strategy to build up an income stream for retirement, does that strategy that you do now take off the table some of the smaller ones?
The little 1%ers that add up.
And these 1%ers can add up.
I don't know about you, but I like saving tax.
Yeah.
I like saving tax dollars, as many as I can.
I always look at it, if you can save yourself, argument's sake, if you can save yourself $1,000 a year in tax, that might not in itself, that seems a good win.
Yeah.
But if you extrapolate that out for 10 years
and compound it,
that works out to be a number that can facilitate a holiday or a car upgrade or assist with some expenses that you have in the future. So they are well worth exploring and structuring.
Especially if you are, on a lower income for whatever reason. It might be, that you're a new mum that's dropped down to like part-time work after maternity leave, or you've got different circumstances where you're cutting back and you're only doing part-time, and your income, is in those lower income earning thresholds, that their strategy is worth doing.
And it's just the important part here is that if you're working with an advisor, they generally will know your circumstances intimately. They know your family intimately. They know what your incomes are, and they will understand when the opportunity arises.
Yeah.
And the ebbs and flow of life is that sometimes partners are working part-time. They're raising children. Sometimes they get to a point where their career says to them that they would like to just step back a little bit, and so their incomes drop back, and some of these strategies come to the table. So that's where you've always got to have a window and a view on the future, and making sure that whatever your planning strategy is, that they are well thought, and they will also consider the wider circumstances and also the current strategies that you're doing. So it's just one of those things, and as we know, they're valuable as they add up over time. Yeah.
So I think we're coming up to our window of time this morning. Was there anything else forefront of mind that you tend to look over or think is worthwhile considering at this time of year?
Yeah, so I always look at, and age to retirement is really, really important. I think if you've got couples, generally, we always don't get married at the same age, and there might be an age difference, so that always brings to the table a planning opportunity. Is your partner or spouse going to get to the superannuation preservation rules earlier, so age 60, for example?
Yes.
Is there an opportunity where you can say, okay, is there ability for me to either make contributions or split contributions across into the partner's name? Yes. So it's not right for everyone, but it is a strategy that we look at. And how does that work in reality? For example, you may be 58, for example. You might be the husband in the family group, and your wife might be 55, and you might be carrying a certain amount of debt, and your plan has just sat down and has discussed with you opportunities around how do you retire debt in the future. Is retirement age 60 going to be relevant for that? Can you access it partially under the transition to retirement rules as well? So that becomes the strategy. And so when you have those discussions with clients, it puts on the table, do you start moving funds from the younger partner to the older partner, with the example of trying to start strategies that will allow you to retire debt from age 60. And so correct me if I'm wrong, but my understanding of that's a contribution splitting strategy. It means that you can, the rules are that you can move up to 85% of your concessional contributions you've made for that year to your spouse, and that's normally done the following financial year. So if you put that money in as of 1st of July onwards, I could say, I could put in my form and move 85% over to my husband. Correct.
In his super fund, and that it's and that forms whatever the concessionals are. So if you put carry forwards in, it counts them. If it's the SG, it counts them. It's whatever the concessional amount you put in, you can put in up to 85% across. Is that right? Yeah. And that's not right for everyone. So, and as I said, that's why working with an advisor in its entirety, a strategy is valuable, but does that strategy affect other strategies that you're planning? And how does that become valuable to you as a couple over the journey? So it's important to note that. Yeah, and I suppose that's the other thing. You talked at the start that a lot of the importance of this is, can you fund these things? Where's that money from? Like, do you need that money? Is it funded? And I guess that as you approach preservation age or retirement at like 60 onwards, when you can access super, it becomes very relevant, because it might be that, you know, you have someone that has a big carry forward cap available and you have some money that you could put into super, but you kind of want that money for a holiday or something within the next 12 months. And if you've got a retiring spouse coming up in the next 6 months, then you can get that tax discount, split it across to them and get it back out. So it's the timing of that, and having someone know your circumstances to be able to say, this actually isn't going to interrupt your cash flow plans at all. We can model this out to show you get a tax discount and can still do what you want.
Correct.
So win-win.
Yeah. So I suppose from a financial planning advisory point of view, we're always looking at opportunities where you can turn on the tap, increase your income.
Yes.
How do you do that? Through tax savings? Are there any ways that we can improve your cash flow? You know, and some of the milestones in life that we get to, we go, some of these strategies might not work always through your life, but suddenly you go into a new career or you step up in income, and that strategy then becomes...
Or your kids move out, or they stop going to school and you don't have to pay for schooling anymore.
Correct. So and that's why I'm saying, having an intimate relationship with your financial planner who knows your circumstances, who know those milestones, will bring those suggestions to the table. And it's not necessarily, for people who are thinking about these strategies, it's not always something that you think of front of mind in life. You go forward, and that's the value of having a relationship with a planning team, because they will bring to the table these suggestions. It may not always be the right timing, but at least you're thorough in looking at all options. Yeah. But as I said, whenever you do a lot of the strategies that we do for superannuation or tax planning strategies in this space, it does warrant making sure that it doesn't impact your ability to have a nice lifestyle as well. Yes. So, yeah.
Wonderful. Anything else you think for end of financial year wrap up?
We could talk about a lot of things. I think today is really just to try and keep it concise. Yeah. Is there ability for you to make some further pre-tax contributions? Mm-hmm. Have you got any needs to make any non-concessional contributions or contributions from your bank account into superannuation for tax planning and also retirement planning? Now, when I say tax planning and that sort of strategy, I think for the long-term gain that you are moving funds from a taxable position to a non-taxable position.
And getting some tax savings along the way, depending on how you're getting them in there.
But the concessional ones is the ones that we always look at and at this time of the year, because they become valuable to you. If you can make those strategies and you can afford to do so, then that equates in a lower tax position for the year. And that's, as I said, there's a range of factors we need to think about. Income, what your tax position is, what your superannuation cap position is, what your overall total super balances are as well. Yes. So it's a wide discussion.
Lots of things to consider, which is why this isn't advice. It's just a general discussion because it's very specific to your own circumstances and goals and cash flows. But I think that's a great overall summary though of going. You know, as June 30 approaches, check your pay slips, have an understanding of what those caps are, the 30,000 concessional, the 120,000 non-concessional. Think about whether or not any of those 1%ers like spouse contributions or co-cons could work for you.
And also understanding what the metrics are, because when you do make pre-tax contributions in, you're not taking tax off the table, you're reducing tax.
Yes.
And that tax will still be paid at the lower tax threshold, but inside the superannuation.
Yes.
But we, I think we'll keep it
wrapped up there before we go into full retirement planning mode. We might save that for the next episode.
That's right. And keeping it simple and for most people, like there's some great strategies that you can utilise that will get you ahead. Yeah. Year on year, they make a lot of sense. What we're trying to do is build up resources
consistently over time
and hold on to more of your own assets. And these strategies help.
Yeah, wonderful. Thank you for your time today.
Thanks, Patrea.